expense, what is your net profit. So that is the normal perception for accountants, but there is much more than this in accounting. So accounting is basically maintaining the records. So we will look at the definition. So, but we just need to clear the accounting, the fundamentals. So who needs accounting? Who need to do it? Everybody need to do. But mostly is the physical job is the the accountants, right? But who need to do, every business need to do it. Even though you are a not for profit organization, you are a profit organization, you are a government organization, you are a startup, everybody need to do their accounting, right? To know how much is your income, how much is your expense, how much assets you have. So do you know in your family business how much is the value of assets you have? You don't need to tell us, but just answer yourself. Do you know how many millions of dollars you have now? I don't think small. Huh? I always big. I always think big. So you will not see me using 100,000. I'll always use millions and billions of dollars. Okay, and also in dollars, not in Myanmar chat. So you need to know that, so that you know how much you have, where you can invest, and how you are going, what is the return on your investments, right? And why do we need it? As we know, for understanding your profit and loss, understanding the returns, how much money you are earning, are you earning enough or not? Right? If your business is earning less, if you have invested, let's say $1 million in any business, and that business is giving you $10,000 a month income, will you be happy? No, right? Why? How you say no? How you compare? How much you want? So means you need to have a target, right? So you may have a target based on, let's say, bank interest. You may target based on other business opportunities, or you may target based on another investment profile that you want to use, right? So you always want to compare your returns, what you are getting, compared to your targets. So, but how will you calculate how much is your actual returns? So actual return is very difficult to measure, and is not, it's very subjective. It depends on what are you looking at. Are you looking at cash flow, or you're looking at accounting profit, or you're looking at value? There are three different concepts of how much money we are getting. You may be investing in a real estate business where you're not getting much rent, but your value of your building and land is increasing very significantly, right? And there is another investment next to it which will give you a lot of rental income, but at the end of the day your land and building value is actually dropping. So which one you will prefer? It depends on, there's no right answer, it depends on your objective. Do you want a regular cash income, or you want value increase? Correct? So it depends on the business objective. What are the business objective? Okay? And who are the target users? So everybody is a target user. Everybody need to understand it, be it from the CEO, the business owner, even the staff of the company. The government need to know how much you are earning, right? So that they can collect the right tax from you. I'm sure not everybody is submitting the right tax, because you have two set or three set of the financial statements, right? In your real life, that's real life, right? That's Myanmar, or even in where I come from, India. We never submit our 100% tax. We submit only 20% of income to the government, and we pay the tax based on that. But government want to know, right? So government finds a way that how to know that how much income you are earning. So government is also trying to understand what is your income levels. Staff need to know, will you be able to pay salary next month or not? Correct? So they also need to have a financial statements. If you are a startup, maybe somebody who is a high profile job, let's say somebody who is established job person who gonna leave his job and come to your company, he need to know how long you will be able to pay the salary. So how he will know? He will look at your financial statements, right? He cannot look at your bank statement. He will not ask you, because if he asks you, yeah, sure, we will pay, don't worry. And then for 1 year you don't pay the salary. But if he has access to your financial statements, he can know. There are indicators that the company is sound enough or not. When you are investing money into the business as an investor, you want to know the company is sound, or not? The money you are put into the company is worthwhile or not? Correct? So from the investor perspective, staff, creditor, whoever is selling you anything for credit, he also need to know this company can pay money on time or not. Correct? So there are a lot of indicators that we will learn today, how to understand that company is solid or not. Okay, so this week we are going to be focusing only up to this part. Next week we'll learn more advanced topics. Okay, so what is financial accounting? So financial accounting, you can assume, is like a process. Okay, so the process starts from recording the financial transactions. So what is a financial transaction?
How much you gain, how much you get, and how much you.
So that is correct definition, but financial transaction means anything, any business transaction that you do which involves money. So you may be paying money physically, or you may not be paying money, but you may have to pay in future. So anything which relates money is financial transaction. Is it okay? Very hypothetical example. Huh? If you love your girlfriend, is it a financial transaction? No, right? You are just loving. There is no money involved. Yeah, you have gifts, but that is not the transaction, right? Correct. So that is not a financial transaction. But if you give a gift to your girlfriend, is that a financial transaction? That is a financial transaction because it involves money or something which can be measured by money. Okay. So any transaction when a business does, which can be measured by money, it is a financial transaction. So it needs to be measurable. So love, emotions, they are not measurable. If let's say you are creating a brand, right? You have a business. For example, let's say Apple. Apple is now worth $1 billion in their brand value. Okay, but if you look at in their balance sheet, there is no money, there is no asset called Apple brand value. Why? Because they are creating it. They are just making it. They didn't buy it from anybody, right? So that becomes their brand value. So creating a brand is not a financial transaction. But buying a brand, paying money for a brand, it is a financial transaction. Because you are paying money. You are measuring it by some way, somehow, right? If you have your own brand, you cannot measure your own brand, or you cannot record, you are not paying to anybody, correct? But if somebody else is buying your brand, it is a financial transaction. So we always record only financial transaction. We don't record non-financial transactions. So when you hire a staff, correct? The staff value is much more than what you pay to them, correct? The staff, the salary is, you are paying them, maybe let's say you hire $1,000, but you know that the skills are valued more than $1,000, correct? But so are you recording $1,000 or more than $1,000? You are not recording for the skills. You are recording only for the money that you are paying to them, correct? And after you have recorded these financial transactions, only financial transactions, the next job is to organize the transactions by account for business decisions. So how you record, how you organize your transactions? So the transactions can be recognized, for example, revenue segmentation, where you are getting your money from. Who are your customers? Are you getting money from Japan, from Australia, from Singapore, from where are your customers coming from, right? So the segmentation means who are your customers, different type of customers. Okay, so we're going to be learning revenue segmentation later. What are the more details in revenue, how we segment the revenue. But the business earns money from different sources. So every different customer who is paying you, not every customer is gonna pay you more money, right? They may be paying you different values. For example, airlines. Somebody is traveling in business class. Somebody is traveling in the economy class. So it's the same plane, but the airline is getting money from two different sources. One who is flying in the business class, one who is flying in the economy class. But if they don't segregate, they have no idea. At the end of the year, was business class successful or not? Correct? If nobody flies in the business segment, so what they should do? They should kick off the business class and put everywhere only economy, because nobody is flying business, right? So business segmentation is very important to understand where your money is coming from and where you need to focus to make it even more, even better. What type of customers paying you money and what type of customers can pay you more money, correct? And also the segment cost center means profitability. Your company may have different type of products. Your company may have different departments. So you want to know what type of products are giving me better profit, or what type of departments are giving me, what type of business are giving me major profits, right? Not just only that, okay, if I have 10 businesses, I continue to run all 10 because I don't know which one is profitable. But overall, I'm making profit. Okay, so let's say there are 10 businesses, two businesses are making $1 million each, so you make 2 million, other business are losing 100,000 each. So in the net you still make money, right? But if you don't segregate, you have no idea. If you segregate, then you know, okay, we keep these two and we kick out the other 8, so we can save, so our net profit will be 2 million rather than 1.2 million, right? So we want to segment the revenue. So how you will know that? By segregating the transactions into each profit center for each segment of revenue, so that we can understand the business position, what is our existing business position. And finally, we group all these transactions into financial statements. So the financial statements includes your profit and loss, in your balance sheet, and your cash flow. So there are three major financial statements that we use in our business. One is profit and loss statement, one is balance sheet, and one is cash flow. We're gonna look at the sample template for that. And in a periodic interval is usually we do the grouping at least once in a year for tax purposes. But business can generate their profit and loss statement every month as well. You can do it even every week if you have a lot of staff and they can generate it if you're using systems. But if you're using manual accounting, you cannot do it every week or every month. It's very difficult, right? So it's mostly we do it every month or once in a quarter or once in a year. Okay, so the accounting works on a double entry system like human. We work on two legs, right? If we have only one leg, we buy another one, but we have to have a balance. So the accounting also works in the same way. It has to have a balance, two transactions, two leg of transactions. Okay, so two double entry system. So every transaction has two sides. Even in a real life transaction, if you are giving something, you are getting something back, correct? Which is measured in value, which is measured in terms of money. When you are selling something, what are you getting back? And what are you giving? Your product or your services, correct? Which is measured at the same value, correct? In olden days, when we were doing the transactions, when there was no money, we used to barter, correct? You take my laptop, I take your laptop, or you take my rice, I take your meat, correct? And the value was like this, same, we work in the same way, right? We sell something and we get something back. So accounting works in two ways. One is something we going out, something is coming in. Either we receiving something physically or right, or we can call it our gain, right? Whatever we are making, or in return of giving something back. So it can again be physical or it can be only a right. So we have two transactions. One is we are giving and one is we are getting back. So we need to record both sides of transaction at the same time. Otherwise your accounting will stumble. Okay, if you have only one leg. For example, sales, either we can sell in cash or we can sell in credit. Okay, how we are going to record, we will look at the next slide, but at the time you just understand there are two types of transactions. What we give is our goods and what we get is cash or right to receive a cash in the future. Hiring a staff, what we get? Services from their staff, which is valued equal to the salary that we are paying, correct? In real life, the staff is giving much more value to the business, more than what you are paying to the staff, right? But you cannot record that extra. You can record only up to the level, up to the salary that you are paying. Okay, So we to record the transaction, we use something called T account. So the T account means we are it's like it's like a T one account. So which we where we record one side